The Internet of Value Part 1, the day money began to move. For thousands of years, humanity has moved information faster than it could move value. A message could cross oceans in seconds, but money still crawled through the same slow systems built half a century ago. Behind every international payment was a maze of correspondent banks, settlement delays, liquidity traps, and hidden fees. A wire transfer from New York to London might appear fast on the surface, but underneath it could pass through 5 different institutions before finally settling days later. This system worked until the world became digital. The internet transformed how we communicate. Emails replaced letters. Streaming replaced DVDs. Cloud computing replaced physical servers. But one thing never truly evolved: money. Banks still relied on Nostro and Vostro accounts, billions of dollars parked across the world just to keep payments flowing. Liquidity sat frozen in vaults instead of moving through the global economy. The financial system had become powerful, but inefficient. Then in 2008, the world witnessed a financial collapse that shook trust in the entire system. Banks failed, governments printed trillions, and people began asking a dangerous question: what if money itself could become digital? Not just numbers inside a bank database, but a programmable asset that could move across the internet the same way information does. The answer first appeared as Bitcoin, but Bitcoin was only the beginning, because while it proved digital money was possible, it could not scale to power the global financial system. The real revolution would come later. A new idea began forming inside the minds of developers, economists, and engineers across the world. What if value could move like information? What if stocks, currencies, real estate, commodities, and debt could all travel instantly across a decentralized network? What if the entire financial system could be rebuilt, not by replacing banks, but by connecting them? This concept became known as something far bigger than cryptocurrency. It was called the Internet of Value, a world where money flows instantly across borders, where assets are tokenized and traded in seconds, where liquidity moves freely between networks, and where dozens of specialized blockchains work together like the infrastructure of the internet itself. But to understand the Internet of Value, we must first understand the architecture behind it, because this new system isn't powered by just one blockchain. It is powered by an ecosystem, a financial operating system made up of multiple networks, each solving a different piece of the puzzle: settlement, liquidity, tokenization, interoperability, data indexing, file storage, and global identity. Over the next chapters of this story, we will uncover how each of these technologies fits together, and why many believe the Internet of Value will become the financial backbone of the 21st century. Because this isn't just about crypto, it's about rebuilding the global economy itself. And the foundations of that system are already being built today, quietly, network by network, protocol by protocol, until one day the world wakes up and money finally moves as fast as the internet. And at the center of this transformation lies the first piece of the Internet of Value architecture, a network designed for one purpose above all else: instant global settlement, a digital bridge for money itself, a technology many believe could power the rails of the new financial system, a technology known as XRP. Part 2, XRP, the Global Liquidity Engine. Before the Internet of Value could exist, the world first needed a new settlement layer, a system capable of moving value across borders instantly, not in hours, not in days, but in seconds, because the greatest weakness of the global financial system was never money itself. It was settlement. Every day banks move trillions of dollars through a network called SWIFT. But SWIFT does not actually move money. It only sends messages between banks. The real money sits inside pre-funded accounts scattered across the world. These accounts are called Nostro and Vostro accounts, and they trap massive amounts of capital inside the global banking system. It is estimated that more than $10 trillion sits idle just to keep international payments functioning. Money that cannot be invested. Money that cannot move freely. Money locked in place simply to maintain liquidity between banks. This inefficiency became the foundation for the next breakthrough: a digital asset capable of acting as a bridge currency between any two fiat currencies in the world. Instead of banks holding dollars in Japan or euros in Brazil, they could convert local currency into a neutral digital asset, send it across a blockchain, and convert it instantly into the destination currency. No middle banks, no trapped liquidity, just pure value transfer. That bridge asset became XRP. The XRP ledger was designed with a very specific goal: global payments. It was built to settle transactions in 3 to 5 seconds. with fees measured in fractions of a cent. And unlike early proof-of-work blockchains, it used a consensus system that required almost no energy. But the real power of XRP was not speed, it was liquidity. Through a system known as on-demand liquidity, financial institutions could use XRP as a temporary bridge between currencies. Instead of funding accounts all over the world, they could source liquidity instantly when a payment was made. Dollars could become XRP. XRP could cross the network in seconds, and seconds later that XRP could become pesos, yen, euros, or any other currency. The entire process could happen faster than a credit card swipe. What once required days of settlement could now occur almost instantly. This concept transformed XRP from just another cryptocurrency into something much larger, a potential liquidity layer for the global financial system. Financial institutions began exploring this technology. Payment providers tested cross-border corridors, and slowly the infrastructure for a new payments network began forming. But the Internet of Value would require more than fast payments. Because global finance is not only about sending money, it is about assets, stocks, real estate, debt, commodities, derivatives, trillions of dollars worth of value that still live inside outdated financial infrastructure. To unlock the full Internet of Value, these assets would need to become digital. They would need to be tokenized. And the next network in our story was designed to do exactly that. A blockchain built specifically for financial markets, trade finance, and asset tokenization. A network that many believe could digitize trillions in global trade. A network known as XDC. Part 3, XDC, Tokenizing Global Trade. If XRP solved the problem of global payments, another challenge remained, one that dwarfed even cross-border transfers. Global trade. Every year the world moves more than $25 trillion worth of goods across oceans, borders, and supply chains. Oil shipments, steel, electronics, food, automobiles. Behind every shipment lies a mountain of paperwork. Letters of credit, bills of lading, invoices, insurance documents, customs forms, financing agreements. Much of this system still operates the same way it did decades ago. Paper documents move slowly between banks, exporters, importers, and logistics companies. Verification can take days, sometimes weeks. Financing can stall while institutions confirm paperwork. This inefficiency creates what economists call the global trade finance gap, a shortage of accessible capital for companies that want to move goods across the world. Today, that gap is estimated to exceed $2.5 trillion. Small and mid-sized businesses often cannot secure the financing needed to ship their products internationally. Not because demand doesn't exist, but because the infrastructure supporting trade is outdated. Enter XDC. The XinFin Digital Contract Network was designed specifically to modernize global trade and finance. Unlike many blockchains built purely for retail crypto activity, XDC focuses on institutional use cases, particularly trade finance. Its hybrid blockchain architecture allows both public transparency and private institutional data layers. This balance gives enterprises something they desperately need: efficiency without sacrificing regulatory compliance. With XDC, financial instruments such as invoices, trade receivables, and letters of credit can be tokenized. Instead of waiting weeks for documents to move between institutions, trade assets can be digitized and verified on a blockchain in real time. A shipment invoice becomes a digital token. That token can be financed instantly by investors anywhere in the world. Capital begins flowing directly to the businesses that need it most. Trade becomes faster, liquidity becomes global, and risk becomes easier to verify. This shift could transform the way international commerce is financed. Rather than relying solely on large banks, the entire investment world could participate in funding global trade. Tokenized trade assets could be bought and sold like digital securities. Investors could finance shipments of steel from Korea, coffee from Colombia, or machinery from Germany. And every step of the process could be tracked securely on-chain. But the Internet of Value still requires more than payments and trade. It needs infrastructure capable of supporting the largest institutions on Earth. Governments, corporations, supply chains, healthcare systems, energy grids, a network designed not just for finance, but for the entire digital economy. The next technology in our story was built by some of the largest corporations in the world. A blockchain governed by global enterprises. A system designed to power trust at scale. A network known as Hedera Hashgraph. Part 4, Hedera, the enterprise trust layer. As the Internet of Value began taking shape, one reality became clear. For this new financial system to truly succeed, it could not exist only within the world of crypto enthusiasts and developers. It needed the trust of the largest institutions on Earth: global corporations, banks, governments, technology companies, organizations responsible for trillions of dollars in economic activity. These institutions require more than innovation. They require stability, security, governance, and performance at massive scale. Because if the Internet of Value is going to support the global economy, it must be capable of processing not thousands of transactions per day, but millions, possibly billions. That is where a different type of distributed ledger entered the story, a network that did not rely on traditional blockchain architecture. A network built around a technology called hashgraph. This network became known as Hedera. Instead of grouping transactions into blocks like most blockchains, hashgraph uses a method called gossip about gossip combined with virtual voting. This structure allows the network to achieve extremely fast consensus while maintaining strong security. Transactions can be finalized in seconds, with predictable fees and extremely high throughput. But the most unique aspect of Hedera is not the technology itself. It is the governance model. Hedera is governed by a council made up of some of the world's largest organizations. Companies spanning industries such as technology, telecommunications, finance, aerospace, and manufacturing. Each council member operates a node and participates in governing the network. No single entity controls the system. Instead, the network is designed to be managed collectively by trusted global institutions. This structure gives Hedera something that many decentralized networks struggle to achieve: enterprise confidence. Large organizations need infrastructure they can rely on for decades, systems that remain stable even as leadership changes or markets evolve. Hedera was built with that long-term reliability in mind. And the network's capabilities extend far beyond simple payments. Hedera supports tokenization, smart contracts, decentralized identity systems, supply chain verification, and digital asset management. Enterprises can issue tokens representing real-world assets. Supply chains can track goods from production to delivery. Governments can explore digital identity frameworks. And financial institutions can build entirely new forms of digital markets. In many ways, Hedera represents the enterprise infrastructure layer of the Internet of Value. But even with payment networks, trade finance blockchains, and enterprise infrastructure in place, one massive challenge still remains. Because the future financial system will not be powered by just one blockchain, or two, or even 10. It will be powered by hundreds, possibly thousands, different networks built for different purposes, different industries, different regions, different technologies. And for the Internet of Value to function, all of these networks must communicate with each other. They must exchange data, assets, and liquidity seamlessly, the same way websites communicate across the Internet today. To solve this problem, a new layer of technology had to be created, a layer designed not to compete with blockchains, but to connect them. A system built to unify the fragmented world of distributed ledgers, a technology known as Quant. Part 5. Quant, the network of networks. As the number of blockchain networks began multiplying across the world, a new problem quickly emerged: fragmentation. Each blockchain had its own architecture, its own rules, its own consensus system, and its own ecosystem of applications. Some specialized in payments, others in smart contracts, some focused on enterprise adoption, others on decentralized finance. But these networks were not designed to communicate with one another. Assets locked inside one blockchain could not easily move to another. Data could not flow freely between systems. Liquidity became scattered across dozens of disconnected networks. It was as if the early internet had developed with thousands of separate websites, but none of them could link to each other. Without interoperability, the vision of the Internet of Value could never become reality. Financial systems cannot function in isolation. Banks must communicate with payment networks. Trade platforms must interact with liquidity providers. Asset tokenization platforms must connect with settlement layers. Every piece of infrastructure must work together. This is where Quant entered the story. Rather than building yet another blockchain, Quant focused on solving the problem of interoperability, connecting networks instead of competing with them. At the center of Quant's technology is a system called Overledger. Overledger acts as an operating system that sits above individual blockchains. Instead of replacing existing networks, it allows them to communicate with one another. Through Overledger, developers can build applications that interact with multiple blockchains simultaneously. A payment might settle on one network, while identity verification occurs on another, and data storage happens on an entirely different system, all seamlessly connected. This architecture introduces a new concept known as multi-chain applications. Rather than relying on a single blockchain, applications can draw from the strengths of multiple networks at once. One chain may offer speed, another security, another regulatory compliance, another decentralized storage. Together they form a unified system, just as the internet connects millions of computers across the world. Interoperability layers like Quant could connect countless blockchain networks into a single digital economy. But interoperability alone is not enough, because blockchains face another fundamental limitation. They are excellent at verifying information that already exists on-chain, but they struggle to access data from the outside world. Financial markets rely on real-time information, prices, interest rates, weather data, shipping updates, election results, commodity markets. All of this data exists outside of blockchain networks. Without reliable access to external information, smart contracts cannot function properly. They cannot respond to real-world events. They cannot power financial agreements. They cannot automate global markets. To solve this problem, another critical piece of the Internet of Value infrastructure had to emerge, a network capable of securely delivering real-world data to blockchains. A bridge between digital ledgers and real-world information. A system known as Chainlink. Part 6, Chainlink, the data bridge. As the architecture of the Internet of Value continued expanding, one critical realization emerged. Blockchains are incredibly powerful at verifying transactions, but they exist inside closed environments. They cannot naturally access information outside their own network. This creates a massive limitation, because financial systems depend on real-world data, stock prices, commodity values, interest rates, exchange rates, weather patterns, shipping logistics, economic indicators. All of these constantly changing data points drive global markets. Yet blockchains cannot simply pull this information from the internet without risking manipulation. If a smart contract relied on a single data source, that source could be hacked, corrupted, or falsified. And if billions of dollars depended on that data, the consequences could be catastrophic. For the Internet of Value to function, blockchains needed a reliable method of receiving trustworthy external information. This challenge became known as the Oracle problem. The solution arrived in the form of a decentralized Oracle network called Chainlink. Chainlink acts as a bridge between blockchains and the real world. Instead of relying on a single data provider, Chainlink gathers information from multiple independent sources. These sources verify and compare data before delivering it to smart contracts. The result is a decentralized network of oracles that can securely feed real-world information into blockchain systems. This capability unlocks an entirely new category of financial applications. Smart contracts can now react automatically to real-world events. Insurance payouts can trigger when verified weather data confirms a natural disaster. Supply chain systems can release payments when shipment data confirms delivery. Financial derivatives can execute based on live market prices. Even complex lending markets can operate without centralized intermediaries. But Chainlink's role goes even deeper. As the Internet of Value expands, trillions of dollars in traditional assets will begin moving onto blockchain networks. Stocks, bonds, real estate, commodities, trade invoices, government debt. All of these assets will require accurate pricing data and verification. Chainlink's Oracle networks can provide this information, connecting decentralized systems with the massive financial databases that already power global markets. This is how blockchain ecosystems begin integrating with traditional finance. But data alone is not enough, because the Internet of Value will eventually represent far more than cryptocurrencies. It will represent real-world assets, and once assets become digital tokens, they must be stored, transferred, and verified securely. But where does all the data live? Documents, contracts, ownership records, legal agreements, images, corporate filings, historical records. All of this information requires reliable storage, not just temporary storage, but permanent storage that can exist for decades or even centuries. To support the future digital economy, entirely new systems for decentralized data storage had to emerge. Networks designed to preserve information across time. Systems capable of storing the building blocks of the Internet of Value itself. Two technologies rose to meet this challenge: a decentralized storage network designed for massive data capacity, and a permanent archive built to preserve humanity's information forever. These networks are known as Filecoin and Arweave. Part 7, Filecoin and Arweave, the memory of the digital economy. As the architecture of the Internet of Value continued expanding, another critical question began to surface. Where would all the data live? Because a global financial system does not only consist of transactions. Behind every transaction lies an enormous amount of information. Contracts, legal documents, asset records, trade agreements, supply chain data, corporate filings, proof of ownership, identity verification. Every digital asset requires data to support it. A token representing real estate must connect to property records. A tokenized bond must reference legal documentation. A trade finance agreement must include invoices, shipping manifests, and insurance policies. Without secure storage for these documents, tokenization cannot function. But traditional storage systems rely on centralized servers. Corporations host massive data centers that store the world's information. While efficient, these systems introduce risk. Data can be lost, servers can fail. Companies can disappear, governments can censor or remove information. For a global financial infrastructure expected to last generations, data storage must be decentralized, permanent, resilient. This need led to the development of a new type of infrastructure, decentralized storage networks. Instead of relying on a single company's data centers, these networks distribute information across thousands of independent computers worldwide. Two networks emerged as leaders in this space: Filecoin and Arweave. Filecoin focuses on decentralized cloud storage. Anyone with unused storage capacity can rent it to the network. Data is encrypted, distributed, and stored across multiple nodes. Participants are rewarded for reliably storing and delivering data. This system transforms global storage into an open marketplace. Companies can store massive data sets without relying on centralized providers. Blockchains can archive important information without overwhelming their own networks. And decentralized applications gain access to scalable, censorship-resistant storage. But some information must be preserved not just for years, but forever. Financial history, public records, scientific knowledge, cultural archives. This is where Arweave plays a unique role. Arweave introduces the concept of permanent storage. Instead of paying for storage month after month, users pay once to store data indefinitely. Through a system known as the permaweb, information can be preserved across generations. Documents stored on Arweave are designed to remain accessible long into the future. For the Internet of Value, this permanence is essential. Financial records must be auditable decades later. Ownership histories must remain verifiable. Digital agreements must survive long after the original participants are gone. Filecoin and Arweave together form the memory layer of the Internet of Value. One providing massive scalable storage, the other preserving critical data permanently. But even with payments, trade finance, enterprise infrastructure, interoperability, Oracle data, and decentralized storage in place, the system still lacks something essential: coordination between blockchains. Because the future financial system will not run on a single network. Different blockchains will specialize in different functions, some optimized for speed, others for security, others for governance, others for data. To truly unlock the Internet of Value, these networks must form entire ecosystems, clusters of interconnected blockchains working together. Just as the Internet connects millions of servers across the globe, two major technologies were built specifically to create these blockchain ecosystems. Networks designed to allow blockchains themselves to communicate and coordinate. The first of these systems is known as Cosmos. Part 8. Cosmos, the Internet of Blockchains. As the number of blockchain networks continued growing, the world began to resemble the early days of the Internet. Thousands of independent systems were emerging, each with its own technology, its own users, its own purpose. But without a method of connecting these systems, they would remain isolated. Separate digital islands. For the Internet of Value to function, blockchains would need to communicate directly with one another. Assets would need to move across chains. Data would need to travel between ecosystems. Applications would need to interact with multiple networks simultaneously. In other words, blockchains would need their own version of the Internet. This idea gave birth to a powerful concept, the Internet of Blockchains, and one of the first networks designed to achieve this vision was Cosmos. Rather than creating a single massive blockchain meant to handle every task, Cosmos introduced a different architecture, a network of many independent blockchains working together. Each blockchain within the Cosmos ecosystem is called a zone. These zones can be customized for specific purposes. One zone may specialize in decentralized finance. another in gaming, another in data management, another in asset tokenization. At the center of this ecosystem sits the Cosmos Hub. The hub acts as a coordinator between zones, allowing them to communicate through a protocol known as IBC, Inter-Blockchain Communication. IBC allows different blockchains to send messages, tokens, and data to each other securely. A token created on one blockchain can move to another without relying on centralized exchanges. Information can flow across the network instantly. This architecture transforms blockchain ecosystems into interconnected digital economies. Developers can build specialized chains while still benefiting from shared communication and liquidity. Instead of competing for dominance, networks collaborate. Each blockchain becomes a module in a larger financial system. But Cosmos offers another powerful advantage: scalability. Traditional blockchains often struggle when too many users compete for space on the network. Transaction fees rise. Processing slows down. Systems become congested. Cosmos avoids this problem by spreading activity across many chains. As new demand emerges, new zones can be created. The network expands organically, like cities growing along an interconnected highway system. This modular architecture could become essential for the Internet of Value, because a global financial system must scale to support billions of people, millions of businesses, and trillions of dollars in daily transactions. But while Cosmos focused on interoperability through independent blockchains, another project approached the problem from a slightly different angle. Instead of building separate chains connected through hubs, this network created a system where many blockchains operate under a shared security framework, a structure designed to unify multiple chains while maintaining decentralized governance. A system known as Polkadot. Part 9. Polkadot, the multi-chain network. As the vision of the Internet of Value expanded, the idea of multiple blockchains working together became impossible to ignore. No single network could handle every task. Payments required speed. Financial contracts required security. Data systems required storage. Enterprise networks required governance. Instead of forcing everything onto one blockchain, the future would be multi-chain. Different networks built for different purposes. But these chains still needed a way to operate together securely. This challenge led to the creation of Polkadot. While Cosmos introduced the concept of interconnected zones, Polkadot approached interoperability through a structure built around shared security. At the center of the Polkadot ecosystem lies the relay chain. The relay chain acts as the core of the network. It provides security, consensus, and coordination for the entire ecosystem. Connected to the relay chain are independent blockchains known as parachains. Each parachain can be customized for a specific purpose. One parachain may specialize in decentralized finance, another may support gaming, another may focus on privacy technologies, another may power enterprise applications. Despite their independence, these parachains share the security of the relay chain. This structure allows projects to build specialized blockchains without needing to create their own security network from scratch. Developers gain flexibility, users gain efficiency, and the ecosystem grows stronger as more chains connect to the network. But the true power of Polkadot lies in cross-chain communication. Parachains can send messages and assets to one another through the relay chain. A token issued on one chain can be used on another. Data generated by one application can be accessed by another. Liquidity begins flowing across the entire network. This structure transforms Polkadot into a kind of blockchain operating system. Instead of isolated networks competing for users, Polkadot enables a cooperative ecosystem where many blockchains operate as components of a larger machine. And as more parachains join the network, the system becomes increasingly powerful. But while interoperability networks like Cosmos and Polkadot build the highways connecting blockchain ecosystems, another technology continues to dominate the world of decentralized applications. A platform that introduced something revolutionary to blockchain technology: programmable financial logic. Code that could automatically execute agreements without intermediaries. Code capable of creating entirely new digital economies. This innovation became known as smart contracts. And the network that brought smart contracts into the mainstream was none other than Ethereum. Part 10. Ethereum, the smart contract revolution. Before the Internet of Value could truly take shape, blockchains needed more than the ability to move money. They needed the ability to execute agreements automatically. Traditional finance relies heavily on intermediaries. Banks verify transactions. Lawyers enforce contracts. Clearinghouses confirm settlements. Each layer adds time, cost, and complexity. But what if agreements could execute themselves? What if financial logic could be written into code? What if contracts could trigger automatically when specific conditions were met? This idea gave birth to one of the most transformative innovations in blockchain history: smart contracts. A smart contract is essentially a program stored on a blockchain. Once deployed, it operates exactly as written. No one can alter it. No intermediary is required to enforce it. And once its conditions are met, it executes automatically. This innovation unlocked an entirely new category of financial infrastructure: decentralized exchanges, lending platforms, tokenized assets, insurance protocols, prediction markets. Entire financial ecosystems could now be built directly on blockchain networks. At the center of this revolution stood Ethereum. Launched in 2015, Ethereum was the first widely adopted blockchain designed specifically for programmable applications. Developers could write code that interacted with digital assets. Users could interact with these programs directly through their wallets. Financial services that once required entire institutions could now run through decentralized software. This movement became known as DeFi, decentralized finance. Suddenly, people anywhere in the world could trade assets, lend funds, borrow capital, or earn yield without traditional intermediaries. But Ethereum did more than power DeFi. It introduced the world to tokenization. Through standards like ERC-20 and ERC-721, developers could create digital tokens representing nearly anything: currencies, utility tokens, ownership shares, collectibles, even real-world assets. This framework laid the groundwork for the tokenized economy that the Internet of Value envisions. However, Ethereum's success also revealed a new challenge: demand. As millions of users began interacting with decentralized applications, the network became congested. Transaction fees rose. Processing speed slowed. The world began searching for new architectures capable of handling massive global scale. High-speed networks capable of supporting millions of users simultaneously. Financial markets that could operate in real time. Applications that could rival traditional financial infrastructure. One of the networks attempting to solve this scalability challenge was built with a very specific goal: extreme speed. A blockchain designed to process thousands of transactions per second. A network that aims to power the next generation of digital markets. A system known as Solana. Part 11. Solana, the high-speed financial engine. As blockchain technology continued evolving, one challenge became impossible to ignore: speed. For the Internet of Value to function at global scale, networks must process enormous amounts of activity every second. Think about the modern financial system. Stock markets execute thousands of trades per second. Payment networks process millions of transactions daily. Global commerce operates continuously across time zones. A blockchain designed to support the future economy must compete with this level of performance. Many early networks struggled with this problem. Decentralization created security, but often at the cost of speed. Transactions could take minutes to confirm, sometimes longer during heavy usage. For everyday users and financial markets, that delay becomes a barrier. A payment system must feel instant. A trading platform must move at market speed. A financial infrastructure must operate without congestion. This is where Solana entered the picture. Solana was built with one primary objective: extreme throughput. The network introduced a unique innovation known as proof of history. Instead of relying solely on traditional block validation methods, proof of history creates a cryptographic timeline of events. Every transaction receives a verifiable timestamp before being added to the network. This allows validators to process transactions far more efficiently. Rather than waiting for global agreement on every step, the network can move forward with a shared sequence of events already established. Combined with additional technologies such as parallel processing and optimized data structures, Solana is capable of processing thousands of transactions per second. Fees remain extremely low, often fractions of a cent. This performance makes Solana attractive for applications requiring rapid execution: decentralized exchanges, high-frequency trading platforms, gaming ecosystems, NFT marketplaces, consumer applications. Entire digital economies can operate on networks capable of processing large volumes of activity without slowing down. But speed alone does not build a financial system. Trust must exist, governance must evolve, and systems must support identity, compliance, and long-term sustainability. Because the Internet of Value will not only power markets, it will eventually interact with governments. institutions, public infrastructure, entire nations. One blockchain project has taken a particularly careful approach to these challenges, focusing heavily on academic research, peer-reviewed development, and long-term governance models. A network designed to support digital identity systems, decentralized governance, and financial inclusion across the globe. A project known as Cardano. Part 12. Cardano, Identity, Governance, and the Future of Trust. As blockchain technology continued advancing, another critical question began to emerge. How would billions of people interact with the Internet of Value? Because a global financial system cannot operate on technology alone, it must also support identity, governance, and trust. Traditional financial systems rely heavily on identity verification. Banks require documentation, governments maintain records, institutions track ownership and compliance. Without identity, financial systems cannot function safely. But in many parts of the world, millions of people lack formal access to these systems. They have no bank accounts, no credit history, no reliable documentation. This creates one of the greatest economic barriers on Earth: financial exclusion. The Internet of Value offers a chance to change this. Instead of relying solely on centralized databases, identity systems can be built directly into decentralized infrastructure. Individuals can control their own digital credentials. Proof of identity, educational records, financial reputation, all stored securely and shared only when necessary. One of the blockchain networks focused heavily on this vision is Cardano. Cardano approaches development through academic research and peer-reviewed engineering. Rather than rushing innovation, its architecture has been carefully designed with long-term sustainability in mind. The network uses a consensus system known as proof of stake, which allows participants to secure the network without energy-intensive mining. Validators stake their assets to participate in consensus, earning rewards while maintaining the network's integrity. This structure enables decentralized participation while keeping energy usage low. But Cardano's ambitions extend far beyond payments. The platform aims to support large-scale systems such as digital identity frameworks, government services, and decentralized governance models. Through these systems, individuals may eventually hold secure digital identities on-chain. Credentials could be verified instantly, educational degrees confirmed without intermediaries, financial history portable across borders. This type of infrastructure could open financial access to billions of people worldwide. Imagine a farmer in a remote region proving crop ownership through a blockchain identity, a student verifying academic records instantly when applying for work abroad, a small business gaining credit access based on transparent financial history stored securely on-chain. The Internet of Value becomes more than just a financial network. It becomes an economic access layer for humanity. But identity and governance are only part of the puzzle, because the next evolution of the Internet of Value involves something far larger than cryptocurrency itself: the tokenization of real-world assets. Stocks, bonds, real estate, carbon credits, trade finance, government debt, entire asset classes moving onto blockchain networks. And when this transformation begins, the scale will be enormous, because the global asset market is not measured in billions. It is measured in quadrillions of dollars, and the technology preparing to bring those assets on-chain is already emerging. The next chapter of the Internet of Value story explores the rise of something that could transform finance forever: the tokenization of the world's assets. Part 13. Tokenizing the world's assets. Up to this point in the evolution of blockchain technology, most digital assets have existed purely within the crypto ecosystem: cryptocurrencies, utility tokens, NFT collectibles. But the true power of the Internet of Value lies far beyond digital coins. Its real potential is the ability to bring real-world assets onto blockchain networks. This process is known as tokenization. Tokenization converts ownership of physical or financial assets into digital tokens recorded on a blockchain. Each token represents a share of the underlying asset. These tokens can then be transferred, traded, or divided instantly across global networks. The implications are enormous, because nearly every asset class in the global economy could eventually be tokenized: real estate, stocks, corporate bonds, government debt, precious metals, commodities, carbon credits, trade invoices, private equity, art, even intellectual property. Traditionally, many of these markets operate through slow and expensive infrastructure. Real estate transactions can take weeks or months to finalize. Private equity investments often lock capital for years, Bond markets involve layers of intermediaries managing settlement and custody. Tokenization has the potential to change all of this. By digitizing ownership, assets can move across the internet instantly. Fractional ownership becomes possible. Investors could buy small shares of assets that were once accessible only to large institutions. A single commercial building could be divided into thousands of digital tokens. Investors around the world could own fractions of that property. Liquidity increases. Barriers decrease. Markets become more efficient. This transformation is already beginning. Major financial institutions have started exploring tokenized securities and digital asset infrastructure. Governments are studying how blockchain technology can modernize capital markets. Entire trading platforms are being built specifically for tokenized assets. The global asset market is estimated to exceed $1 quadrillion when all financial instruments are combined. If even a fraction of these assets move onto blockchain networks, the scale of the Internet of Value could become enormous. But tokenization introduces another critical requirement: stable pricing. Because when assets move across blockchain networks, participants need a reliable way to measure value. Volatile cryptocurrencies alone cannot support global commerce. Businesses need predictable settlement. Governments need stable units of account. Institutions require digital assets that maintain consistent value. This is where another category of digital assets enters the picture. Assets designed to mirror the value of traditional currencies. Digital dollars, digital euros, digital yen. These instruments are known as stablecoins, and they may become one of the most important building blocks of the Internet of Value. Because stablecoins are not only tools for crypto trading, they may eventually serve as the digital cash layer of the global economy. But stablecoins are only the beginning, because governments themselves are now exploring the creation of digital currencies, central bank digital currencies, or simply CBDCs. Part 14, Stablecoins, the digital cash layer. As tokenization begins transforming global markets, one critical requirement becomes impossible to ignore: stability. Financial systems cannot operate efficiently if the primary medium of exchange fluctuates wildly in value. Businesses need predictable pricing. Governments require reliable units of account. Consumers must trust that the money they hold today will maintain roughly the same value tomorrow. While cryptocurrencies introduced revolutionary technology, many of them experience large price swings. This volatility makes them difficult to use for everyday commerce: buying groceries, paying employees, settling international invoices. For the Internet of Value to support the real economy, a new type of digital asset had to emerge: assets designed to maintain stable value while still benefiting from the speed and efficiency of blockchain networks. These assets became known as stablecoins. Stablecoins are digital tokens pegged to traditional currencies, most commonly the United States dollar. Each token represents one unit of fiat currency held in reserve or backed by financial assets. In simple terms, a digital dollar on a blockchain. But the implications of this concept are enormous. Stablecoins combine the stability of traditional money with the efficiency of blockchain technology. Payments can move globally within seconds. Transaction costs drop dramatically. Settlement becomes nearly instant. And financial access expands beyond traditional banking infrastructure. Someone with nothing more than a smartphone and an internet connection can participate in the digital economy. Businesses can send cross-border payments without relying on slow banking corridors. Markets can operate 24 hours a day, 7 days a week. Stablecoins have already become one of the fastest-growing sectors in digital finance. Billions of dollars move through stablecoin networks every day. Traders use them to move capital quickly between markets. Businesses use them to settle international transactions. Developers use them as the foundation for decentralized financial applications. But stablecoins are also attracting the attention of major financial institutions. Banks are beginning to explore issuing their own digital currencies. Payment companies are experimenting with blockchain-based settlement systems, and new stablecoin projects are emerging that aim to integrate directly with institutional financial infrastructure. Some of these projects are designed specifically to interact with payment networks like those built around the Internet of Value. Stable digital assets capable of moving seamlessly across multiple blockchains. Stable liquidity layers connecting tokenized markets. Stable currencies powering the new digital economy. But as stablecoins continue expanding, governments around the world are paying close attention. Because if digital dollars begin circulating across decentralized networks, central banks must consider how they will participate in this new financial landscape. Many nations have already begun exploring the creation of their own digital currencies. State-backed versions of money issued directly by central banks. These systems could transform how monetary policy operates in the digital age. They are known as central bank digital currencies, or simply CBDCs. Part 15. CBDCs. Governments enter the digital era. As blockchain technology reshaped finance, governments around the world began facing an unavoidable question. If money itself is becoming digital, who will control it? For centuries, central banks have managed national currencies. They regulate supply, control interest rates, stabilize economies during crises. But the rise of stablecoins and decentralized financial systems introduced a new dynamic. Digital currencies were now circulating outside traditional government infrastructure. Billions of dollars moving across global networks without relying on central banking systems. Naturally, policymakers took notice. Many governments began researching how digital currency could be integrated directly into their own monetary systems. This research gave birth to a new concept, central bank digital currencies, or CBDCs. A CBDC is essentially a digital version of a nation's fiat currency issued directly by its central bank. Unlike cryptocurrencies, CBDCs are not decentralized. They are fully backed and controlled by the issuing government, but they still benefit from the technological advantages of blockchain-inspired systems, faster payments, transparent record-keeping, programmable monetary policy, reduced reliance on physical cash. The potential implications are enormous. Payments between citizens and governments could occur instantly. Tax refunds, social benefits, and stimulus payments could be distributed in seconds. Cross-border settlement between central banks could become dramatically faster. Even wholesale banking systems could be modernized through digital settlement layers. Today, dozens of countries are actively researching or testing CBDCs. Some have already launched pilot programs. Others are developing infrastructure for future deployment. Major economies are exploring how digital currencies could interact with existing financial networks. But CBDCs do not exist in isolation. They will likely interact with the broader Internet of Value ecosystem, payment networks, stablecoin markets, tokenized asset platforms, interoperability systems, Oracle networks. The digital financial infrastructure being built today may eventually connect governments, institutions, and individuals within a shared technological framework. Some networks may specialize in public infrastructure, others may focus on private financial markets. Still others may operate as settlement layers between currencies. The Internet of Value is not replacing the financial system, it is transforming it, integrating old infrastructure with new digital rails. But once digital currencies, tokenized assets, and decentralized financial systems begin interacting at global scale, something even larger begins to happen. Liquidity begins to move differently. Capital flows faster. Markets operate continuously. Financial power shifts. The systems controlling liquidity today may not look the same tomorrow. And the next chapter of this story explores how the Internet of Value could reshape global finance itself. The battle for liquidity, the race for financial infrastructure, and the transformation of economic power in the digital age. Part 16. Liquidity, the fuel of the digital economy. At the heart of every financial system lies a single invisible force. Liquidity. Liquidity is what allows markets to function. It is the ability to move capital quickly and efficiently between participants. Without liquidity, markets freeze, trades fail, businesses struggle to operate, economic growth slows. In today's financial system, liquidity moves through a complex network of banks, clearinghouses, and financial intermediaries. Capital flows through layers of institutions before reaching its destination. Every step introduces delay. Every intermediary introduces cost. Trillions of dollars remain locked inside financial infrastructure simply to maintain this system. But the Internet of Value introduces a new possibility. Liquidity that moves instantly. Liquidity that flows freely across digital networks. Liquidity that is not trapped inside individual institutions or geographic borders. Through blockchain technology, liquidity becomes programmable. Assets can be exchanged automatically. Markets can operate continuously. Capital can move anywhere in the world within seconds. This transformation could fundamentally reshape global finance. In the traditional system, financial power is concentrated within large institutions that control payment rails and settlement infrastructure. Banks act as gateways to the financial system. But in the Internet of Value, access to financial infrastructure becomes more open. Networks replace intermediaries. Protocols automate processes that once required entire institutions. Liquidity begins flowing through decentralized systems. However, the shift does not eliminate institutions. Instead, many of them are adapting. Banks are exploring blockchain settlement layers. Financial institutions are building tokenized asset platforms. Payment providers are integrating digital liquidity networks. The new financial system will likely combine traditional institutions with decentralized technology, a hybrid infrastructure, old systems connected to new rails. But this transformation introduces another powerful concept. Liquidity no longer needs to remain tied to a single asset or network. Through interoperability systems, liquidity can move between chains. Stablecoins can act as bridges between markets. Digital assets can provide settlement layers for multiple currencies. Capital becomes fluid, markets become interconnected, and global finance begins operating at internet speed. But as liquidity becomes digital, another transformation begins to unfold. Assets themselves begin moving onto blockchain networks. Entire financial markets start migrating into tokenized ecosystems. Stocks trading around the clock, real estate ownership recorded on-chain, commodities moving through digital settlement systems. The next chapter of the Internet of Value explores how tokenized markets may reshape the entire global financial landscape. Because once assets become digital, markets never truly close again. Welcome to the era of 24/7 financial markets. Part 17. The Rise of 24/7 Global Markets. For centuries, financial markets have operated within strict boundaries. Stock exchanges open in the morning and close in the afternoon. Banks shut their doors at the end of the business day. International payments pause over weekends and holidays. Even in a global economy, financial infrastructure still operates on schedules designed decades ago. But the Internet never sleeps. Information flows continuously across the world. Messages travel instantly across continents. Digital communication does not pause when markets close. As assets become tokenized and financial systems move onto blockchain networks, markets themselves begin evolving toward the same continuous model, a 24-hour global financial system. In the Internet of Value, assets exist as digital tokens. Ownership records live on distributed ledgers. Transactions can occur anytime participants choose. Markets are no longer restricted by geography or trading hours. A tokenized stock could trade at midnight in Tokyo. A real estate token could be purchased in New York while investors in Europe sleep. Commodity markets could operate continuously as global supply chains move goods across oceans. Liquidity becomes global. Markets become permanent. This transformation introduces profound efficiency. Settlement becomes nearly instant. Ownership records update immediately. Capital moves without waiting for banking hours or clearing cycles. Investors gain greater flexibility. Businesses gain faster access to funding. Economic activity accelerates, but the implications extend beyond speed. A continuous global market also increases accessibility. Traditional financial systems often limit participation to specific regions or institutions. Many markets require large minimum investments. Others restrict access based on geography. Tokenization changes this structure. Fractional ownership becomes possible. A single asset can be divided into thousands of digital shares. Individuals across the world can participate in markets once reserved for institutional investors. Someone with a smartphone could own a fraction of a commercial building in London, or a share of a renewable energy project in Brazil, or a portion of a global infrastructure fund. Markets become more inclusive. Capital becomes more democratic. However, with this expansion comes a new challenge: coordination. Because when financial markets operate continuously across dozens of blockchain networks, the system must remain synchronized. Assets must remain verifiable. Prices must remain accurate. Transactions must remain secure. This is where the entire architecture of the Internet of Value begins working together. Payment networks, interoperability layers, Oracle systems, data storage networks, tokenization platforms, identity systems. Each component supports the others. Together they form a digital infrastructure capable of supporting global markets at unprecedented scale. And as this infrastructure continues evolving, The final pieces of the Internet of Value begin falling into place. Because once global markets become digital, once liquidity flows freely across networks, once assets move at internet speed, the world begins approaching something entirely new: a unified digital financial system, the foundation for a new era of economic infrastructure. The final chapters of this story reveal how all these technologies come together, and what the completed Internet of Value may ultimately look like. Part 18: The Global Financial Operating System. As the pieces of the Internet of Value begin falling into place, a larger picture starts to emerge. Individually, each technology we have explored solves a specific problem. One network focuses on payments, another on interoperability, another on smart contracts, another on data storage, another on enterprise infrastructure. But when these systems begin connecting together, something far more powerful begins to form. Not just a collection of blockchains, but an entirely new financial operating system. A digital infrastructure designed to support the movement of value across the entire global economy. Just as the Internet became the operating system for information, the Internet of Value may become the operating system for money and assets. Think about how the Internet functions today. When someone sends an email, dozens of invisible systems work together behind the scenes. Servers process requests. Protocols route information. Data travels across networks spanning continents. The user sees a simple action, but beneath the surface lies an enormous web of interconnected infrastructure. The Internet of Value may function in a similar way. When someone transfers money in the future, multiple networks may quietly work together behind the scenes. A stablecoin could represent the currency. A settlement layer could finalize the transaction. An oracle network could verify external data. A decentralized storage system could preserve records. An interoperability protocol could connect multiple blockchains, all within seconds. From the user's perspective, the experience could feel as simple as sending a text message. But underneath lies a sophisticated digital financial machine. This new infrastructure may not replace banks, governments, or financial institutions. Instead, it may modernize the rails they operate on. Banks could settle transactions instantly across blockchain networks. Governments could distribute funds through digital currency systems. Corporations could manage global supply chains through tokenized assets. Investors could access markets anywhere in the world. The Internet of Value becomes the connective tissue linking these systems together, a shared technological backbone supporting the movement of global capital. And the scale of this transformation could be extraordinary. Today, global financial assets are estimated to exceed $1 quadrillion when including all derivatives, securities, real estate, and financial instruments. Even a small portion of this value migrating onto blockchain networks could reshape the financial landscape. Entire industries could evolve. New markets could emerge. Financial access could expand to billions of people. But such a transformation does not happen overnight. Infrastructure must mature. Regulations must evolve. Institutions must adapt. Technology must prove reliable at global scale. Yet the direction of progress appears clear. The building blocks of the Internet of Value are already being assembled, network by network, protocol by protocol. And as these systems continue integrating with one another, the final phase of the story begins to unfold. The moment when the Internet of Value stops being a concept and becomes the financial infrastructure of the world. Part 19: When the system goes live. For years, the Internet of Value has existed mostly in the background. Developers building protocols, institutions testing blockchain infrastructure, governments studying digital currencies, pilot programs running quietly behind closed doors. From the outside, progress can appear slow, but infrastructure revolutions rarely happen overnight. The Internet itself followed a similar path. In the early days, only a small number of people understood what it might become. Universities experimented with networks, governments funded research, engineers built protocols few outside their field even recognized. Then one day the infrastructure reached a tipping point. Suddenly the tools were ready. Web browsers appeared. Companies moved online. Entire industries transformed almost overnight. The Internet of Value may follow a similar trajectory. Much of the technology is already built. Settlement networks, smart contract platforms, oracle systems, tokenization frameworks, interoperability layers, decentralized storage, identity systems. Each component of the new financial architecture already exists. What remains is integration. As institutions begin connecting these systems together, adoption could accelerate rapidly. Banks integrating blockchain settlement, governments launching digital currencies, corporations tokenizing assets, payment providers connecting to global liquidity networks. Once these systems begin interacting at scale, the experience for everyday users may feel surprisingly simple. A person sends money across the world. The transaction settles instantly. Behind the scenes, multiple networks may have participated. A stablecoin representing the currency, a settlement layer confirming the transfer, an oracle verifying exchange rates, an interoperability protocol routing the transaction between chains. But the user simply sees a payment completed in seconds. This is how infrastructure revolutions often unfold. The complexity disappears beneath seamless interfaces. Just as the internet transformed communication without most people understanding how data packets move across networks, the Internet of Value may transform finance without users ever seeing the layers beneath. But when this system fully activates, its effects could be profound. Global payments become nearly instant. Asset markets operate continuously. Capital flows more efficiently across borders. Financial services become accessible to billions of people previously excluded from traditional banking. Entire industries begin evolving around the new infrastructure. Trade, finance, energy, real estate, supply chains, digital identity. Every sector of the global economy interacts with value. And when value begins moving at internet speed, the ripple effects reach everywhere. But one final question remains. What does the completed Internet of Value actually look like? What happens when all of these technologies operate together? The final chapter of this story reveals the full picture. Part 20, the completed network. At first, the Internet of Value may not look like a revolution. There may be no single moment when the world suddenly announces that the system has arrived. Instead, the change may happen quietly. One institution at a time, one payment rail at a time, one tokenized asset at a time. Banks begin settling transactions faster. Corporations begin digitizing supply chains. Governments begin issuing digital currencies. Financial markets begin operating around the clock. Each development appears small on its own, but together they form something far larger, a new financial infrastructure layered across the global economy. In this completed system, different technologies perform different roles. Payment networks move money across borders in seconds. Liquidity bridges allow currencies to convert instantly. Smart contract platforms automate agreements and financial services. Oracle networks deliver real-world data to digital markets. Decentralized storage systems preserve the records behind every transaction. Interoperability layers connect networks into a unified ecosystem. Identity systems allow individuals to verify themselves securely across digital platforms. Tokenization platforms transform physical assets into digital representations. Each piece functions like a component of a vast machine. Together they form the architecture of the Internet of Value. Just as the Internet connected computers into a global information network, this system connects assets, currencies, and financial infrastructure into a global value network. Money moves like information. Ownership transfers instantly. Markets operate continuously. Liquidity flows freely between economies. In this world, sending value across the globe becomes as simple as sending a message. A small business can receive international payments instantly. Investors can access markets anywhere in the world. Individuals can store and control their financial identity securely. Entire economies become more connected, more efficient, more accessible. This transformation may not eliminate traditional institutions. Banks, governments, and corporations will likely remain important participants, but the infrastructure supporting them will evolve. The rails will become digital, faster, more transparent, more interconnected. And as this new system matures, it may unlock economic opportunities for billions of people who have never fully participated in the global financial system. The Internet of Value is not just about cryptocurrency. It is about rebuilding how value moves through the world, from payments to trade, from finance to ownership, from local economies to global markets. And while the final shape of this system is still forming, one thing is becoming increasingly clear. The foundations are already being built, network by network, protocol by protocol, layer by layer, until one day the world wakes up to a financial system that feels entirely different. A system where value moves as freely as information, a system where markets never truly close, a system where the global economy operates on digital rails. the Internet of Value. Subscribe to LTL Productions to show your support for free. Thank you.